We now come to the asset management industry. This is a very large industry with about 79 trillion in assets under management, and this number is from the end of 2017. The assets under management number has been growing over the last few years, and obviously it's expected that this will continue to go up. The industry is highly competitive. There are a variety of firms which offer asset management services. We can have relatively small, pure play asset managers who are focused on managing assets. And we can also have large diversified banks or insurance companies that offer asset management services. There is a categorization that is often made in asset management which has to do with sell side firms versus buy side firms. Sell side firms refers to brokers or dealers that sell securities to clients, and they also provide investment research and recommendations. These recommendations are made to investment management companies or individual clients. Buy side firms are investment management companies that use the services of sell side firms. In other words, they buy the services of sell side firms. That's why they are called buy side firms. Over here, I've simply reproduced an exhibit from the curriculum which shows the market size across different regions. And what we see is that of the total assets under management of 79 trillion, a large percentage comes from North America and Europe. But the other markets are becoming larger and they are growing at a relatively fast rate. In this section, we have 4 subsections that are shown here, and we will go over each of these subsections. A major distinction in the asset management industry is between active management and passive management. Active asset managers attempt to outperform a predetermined performance benchmark. So for example, if the performance benchmark is the S&P 500, then active asset managers will try and create a portfolio of stocks which will outperform the S&P 500. On the other hand, passive asset managers attempt to match returns of a predetermined benchmark. So here again, if the predetermined benchmark is the S&P 500, then passive managers will create a portfolio that replicates the S&P 500 and therefore has similar returns as the S&P 500. When we look at the overall market, the market share by assets for active managers is 82% versus only 18% for passively managed assets. So this shows that the industry is dominated by active managers. When we look at the market share by revenue, the difference is even more stark. Active managers represent 94% of the revenue versus only 6% for passive managers. The reason for this is that active managers are doing more work and their fees are more compared to passive managers. So that's why we have such a large number over here. Now, somewhere between active strategies and passive strategies, we have smart beta strategies. The idea here is that returns are based on several factors. So returns can be based on size, value, momentum, or dividend characteristics. Smart beta strategies are based on these factors, and they use simple, transparent, rule-based strategies as a basis for investment decisions. So unlike active management or active strategies where there is a lot of research, so there might be fundamental research or quantitative research that goes into deciding what securities to buy, with smart beta, the decisions are more rule-based. So in that sense, this is somewhat similar to passive investing, but it is also a little more sophisticated because these different factors are considered, and we also have rules that help decide which securities to buy. The fees associated with smart beta strategies tend to be higher than the fees associated with passive investing, but lower than the fees associated with active investing. Also, the turnover associated with smart beta strategies is higher than the turnover associated with passive investing. Another important distinction in the investment management industry is between traditional and alternative asset managers. Traditional asset managers focus on long-only equity, fixed income, and multi-asset investment strategies. So by multi-asset investment strategies, we refer to strategies that involve both stocks and bonds. Alternative asset managers focus on alternative investments such as hedge funds, private equity, venture capital, real estate, and commodities. With respect to traditional managers, the major revenue source is asset-based management fees. So they manage a certain amount of assets, and then the fee is based on assets under management, which would typically be a fixed fee. So here we don't really have much of a performance fee. Alternative managers, however, charge both an asset management fee and a performance fee. This performance fee is often referred to as carried interest. In recent years, the distinction between traditional and alternative asset managers has become blurred. So we have traditional asset managers who are now offering high-end products, higher margin products, which might include alternative investments and where an incentive fee is charged. At the same time, alternative managers are moving into the traditional space by offering retail versions of their alternative strategies. Now, these retail versions are typically offered in the form of pooled vehicles such as mutual funds. These mutual funds tend to be highly regulated compared to other alternative investments. Also, the underlying assets tend to be fairly liquid. And with such investment vehicles, the fee is based on assets under management and there are no performance fees. Coming now to the ownership structure. Most asset management firms across the world are privately owned. Now, in a privately owned context, what clients are often interested in is whether the owners have their own money at stake. So, if owners have their own money in the firm, then that is viewed favorably because there is an alignment of management and client interests. There are a few publicly traded asset managers, but these few companies have substantial assets under management. Globally, there were approximately 30 such companies by the end of 2016. As mentioned earlier, there are some large diversified financial services companies which have asset management divisions. We now come to asset management industry trends. There are three major trends that we need to be aware of. The first is growth of passive investing. The second has to do with big data. And the third has to do with robo-advisors. Let's start with the growth of passive investing. Over the last decade, there has been a tremendous increase in the amount of assets that are passively managed. The curriculum shows an exhibit where in 2008, the assets that were passively managed were roughly 722 billion. And in 2016, this number went up to nearly $3.5 trillion. So there has been tremendous growth here. There are two major reasons for this growth. One has to do with the fact that the cost of passive investing is much lower than the cost of active investing. And the reason is straightforward. With active investing, there's a lot of cost associated with research, whereas with passive investing, we are following a given index, so the cost of research is much lower. The other reason has to do with what I call the elusive alpha. In markets that are efficient, such as US large cap securities, achieving an abnormal return is very difficult. So active investing does not make too much sense. In efficient markets, generally passive investing is more logical. So for these two reasons, the growth in passive investing has been tremendous. Now, there's another factor that you need to be aware of. This passive market is fairly concentrated, and the curriculum shows another exhibit which tells us that approximately 70% of this market is addressed by the three largest players. And those three largest players are iShares, Vanguard, and State Street Global Advisors. The second trend is big data in the investment process. So, here, if we look at the last few decades, let's say going from 1970 to now, the amount of data that we have access to has grown exponentially. And in fact, most of the data that we have now was created in the last few years. When we talk about data, there is a distinction between structured data and unstructured data. Structured data might include security prices or an order book that is maintained by a broker, whereas unstructured data does not have any clear structure. So, for example, information that we get from satellite images or information that is contained in Twitter feeds or Facebook or other social media would fall under unstructured data. This vast amount of unstructured data is generally what is referred to as big data. Financial analysts and researchers use advanced statistical and machine learning tools to process this new data. So, for example, machine learning tools can be used to analyze comments that customers are making on Facebook and determine whether a given product will be successful or not. Also, these tools can be used to analyze satellite images of parking lots to try and estimate the future sales of a given store. So, there is a tremendous amount of analysis that can be done based on both structured and unstructured data. The third trend has to do with robo-advisors. This is where technology is used to provide various wealth management services. So, for example, an individual can log on to a website, provide information about his salary, how many years to retirement, his basically risk tolerance, and so on. And then a computer system can analyze the information that is provided and suggest a retirement plan. The system could also possibly suggest an appropriate asset allocation for the investor. There is a growing demand for such services from mass affluent and young investors. So, what does mass affluent mean? If we look at different levels of affluence, one variable is the amount of liquid assets. Liquid assets might vary from very little to, say, $10,000 to 100,000 to much larger numbers. When we say mass affluent, we are referring to the higher end of the mass market, which would be somewhere over here. So, people who have liquid assets in the $10,000 to $100,000 range and with an annual salary of about $75,000. So, this would be the mass market. It is often called the higher end of the mass market. And then above this, we have the affluent market. Now, this group wants to invest. This group needs investment advice, but they cannot afford personalized advice. So, for this group, robo-advisors or technology-based services make a lot of sense because the cost of technology services tends to be lower than the cost of seeking an individual investment advisor. This market is growing because existing players are offering robo-advisory services, but we also have new entrants. So, for example, historically, asset managers and wealth managers have provided this kind of service, but now also insurance companies and banks are entering the space. It is also likely that in the near future, large technology companies that have access to relevant data might also enter the space. So, analysts believe that robo-advisory services will increase substantially in the near future. Pooled investments. Here we are talking about situations where several investors pool their money or a group of investment managers manage the money. The different kinds of investment products that we will look at include mutual funds, exchange traded funds, separately managed accounts, hedge funds, and private equity funds. On this slide, we are simply showing that an investor can participate in a mutual fund or an exchange traded fund with a relatively small investment of $50 or more. For a separately managed account, an investor needs typically at least $100,000. and to participate in a hedge fund or a private equity fund, a minimum investment of 1 million is required. These are representative numbers and obviously vary from region to region. The high-level message is that investors can participate in mutual funds and exchange-traded funds with a relatively small investment, whereas a significant investment is needed for hedge funds and private equity funds. Let's start with mutual funds. The way the learning objective is structured, you need to understand mutual funds, and then you need to understand how other investments are different from mutual funds. A mutual fund is a commingled investment pool in which each investor has a pro rata claim on the income and value of the fund. Consider the following example. An investment firm raises 100,000 from 5 investors and issues 10,000 shares. Each share has a value of $10. Here are the 5 investors. We have 3 individual investors and 2 institutions. Here are the amounts that each investor has invested, and notice that the number of shares and the percentage of total is based on the amount invested relative to the total amount. So John gets 400 shares, Jill gets 600 shares, and so on. The value of each share initially is $10. When the mutual fund, also called the investment firm, gets this money from the various investors, this money is then invested in shares or stocks. Let's say that this is a stock-based mutual fund. Later we'll see that there are other types of mutual funds also. But the money is invested in stocks. Initially, the 100,000 is invested. Let's say that at the end of 1 year, this 100,000 invested in shares grows to 150,000. What has happened then is that the value of each share will go up roughly to $15, which means that in the context of this particular mutual fund, each investor is 50% richer. The major benefit of this structure is that you can have 1 or 2 managers managing this entire pool of money. That way, John, Jill, Joe do not need to individually hire an investment manager to manage their small amounts of money. So clearly, this is a more cost-effective way of managing money relative to each investor managing his or her own money. Let's understand a few more points related to mutual funds. The first is net asset value. This refers to the value of assets minus liabilities. In the example I just gave you, there were no liabilities, so my NAV initially was only 100,000. Often you see something called net asset value per share. This refers to the total net asset value divided by the number of shares. In our example, the number of shares was 10,000, so our NAV per share was $10. If the company had some liabilities, then those liabilities would have to be subtracted from assets to come up with the net asset value. When we say mutual funds, we are typically referring to open-end funds which accept new investment money and then issue additional shares. Let's say that after 1 year, several new investors want to join this fund because they have been impressed by the performance. And let's say that $50,000 come in from additional investors. What the investment firm will then do is issue new shares. These are called open-end because they accept new money. These funds are also called evergreen funds. If investors want to redeem their shares, then what the investment fund does is it sells the relevant number of shares based on end of day prices, and the money is given back to the investor. Because of this, generally the share price of an open-end fund will trade very close to the net asset value per share. Unlike open-end funds, closed-end funds do not accept new investment money. This means that if a closed-end investment fund has issued 10,000 shares, then that's the number of shares that will remain. Those shares are traded in the market. If an investor has 500 shares, he can get his money back by selling those 500 shares to another investor. It is important to understand the main differences between open-end funds and closed-end funds. Open-end funds trade at NAV or very close to NAV, whereas closed-end funds can trade at a premium or a discount to NAV or at NAV. Given that over here, the underlying stocks or the underlying shares are not being sold, it is possible that the share price of the closed-end fund or the units issued by the closed-end fund trade at a price other than NAV. Another key point is that units issued by closed-end funds trade like regular company shares. They can be purchased on margin, they can be shorted, they can be bought or sold anytime during the trading day. On the other hand, with open-end funds, the shares of the open-end fund are bought or sold based on closing prices. In other words, if you invest in an open-end fund, you can only buy or sell once a day based on closing prices. A few other general remarks. Open-end funds tend to be much more popular in most countries, and also when we refer generically to mutual funds or investment companies, we are talking about open-end funds rather than closed-end funds. You also need to understand the distinction between a no-load fund and a load fund. All mutual funds will have some sort of a annual fee which is based on assets under management. This might be about 2% of the total assets under management. In addition to this 2%, some mutual fund companies charge a fee when somebody enters the fund, or they might charge a fee when an investor exits the fund. Those sorts of funds where a fee is charged in addition to this 2% annual fee are called load funds. If no fee is charged other than the regular annual fee, then the fund is called a no-load fund. A mutual fund can also be categorized based on types of investments. If a given mutual fund invests in money market instruments such as T-bills and other liquid short-term bonds, then it will be called a money market fund. If it invests mostly in bonds, then it will be called a bond mutual fund. A stock mutual fund will invest in stocks. Index mutual fund will invest in shares that are in a particular index such as the S&P 500. Next, we talk about exchange traded funds. Like mutual funds, exchange traded funds are a pooled investment vehicle and are often based on an index. With an index mutual fund, investors buy shares directly from the fund. With exchange traded funds, investors buy shares from other investors. What we've done here is identify the difference between a mutual fund and an exchange traded fund. When we say index mutual fund, that is what I just talked about, where we have a mutual fund that is based on a particular index. So investors buy shares directly from the fund. That's the structure that we just talked about. With exchange traded funds, the structure is a little more complicated and investors buy shares from other investors. Roughly speaking, here is how it works. I don't think this is overly testable, but I will cover it briefly nevertheless. A fund sponsor, this is the exchange traded fund sponsor, identifies a basket of shares and then approaches a institutional investor. The institutional investor buys the shares and deposits those shares with the fund sponsor. In return, the institutional investor receives creation units, which typically represent 50,000 to 100,000 ETF shares. Those shares can then be sold to the public by the institutional investor. Again, I'll emphasize, this is very high level. You don't need to go into the details. From a testability perspective, this material is important. You need to understand the similarities and differences between mutual funds and exchange traded funds. Exchange traded funds combine the features of closed-end and open-end funds. They track NAV like open-end funds. In fact, to be more specific, open-end funds track NAV the most. Closed-end funds track NAV the least. And exchange-traded funds track NAV but not as well as open-end funds. And the reason is based on their structure. Again, you don't need to get into the detailed mechanics. Exchange traded funds trade like closed-end funds. As I mentioned earlier, the shares issued by a closed-end mutual fund company will trade continuously, as opposed to open-end funds, which can only trade based on end-of-day prices. You can buy exchange traded fund shares on margin. You can do short selling. So essentially, they behave a lot like regular shares. Expenses for ETF shares tend to be low relative to mutual funds, but a brokerage fee needs to be paid. Unlike mutual funds, exchange traded funds do not have a capital gains distribution. This is generally considered to be an advantage, and I'll explain in simple terms what this means. For a mutual fund, if the underlying shares are sold at a gain, then there are capital gains taxes that need to be paid in some form by the shareholders. Whereas with exchange traded funds, that is not the case. As you might imagine, there are lots of details that I have skipped, but from an exam perspective, what you see here is most important. Separately managed accounts, or SMAs. These are also called managed accounts, wrap accounts, and individually managed accounts. Here the investor owns the underlying shares, and the question is, how is this different from a mutual fund? If you recall, with a mutual fund, the mutual fund owns the underlying shares, and then the mutual fund issues its own units or shares. The investor owns the mutual fund units or shares, and the mutual fund owns the underlying shares. With SMAs, the investor owns the underlying shares. The way you can think of it is as follows. The investor, through maybe a brokerage account, owns the underlying shares, and we have an investment manager who can log into the brokerage account on behalf of the investor and buy or sell shares. But those shares that are bought and sold belong to the investor. Given this structure, tax implications can be considered when buying or selling. So if for a given investor it makes sense to sell a particular share or buy a particular share based on tax considerations, that can be done with SMAs, but with mutual funds that cannot be done. Typically, SMAs require a high initial investment. Moving now to hedge funds. Hedge funds are private investment vehicles that typically use leverage, derivatives, and long and short investment strategies. Different types of hedge funds use different techniques and strategies, but there are some characteristics that tend to be common across most hedge funds. Those characteristics are shown here. Many hedge funds use short selling. This short selling may be directly in the sense that a particular stock that is considered overvalued, the hedge fund might go short on that stock, or sometimes short positions can be created synthetically using options, futures, and credit default swaps. In other words, hedge funds try to take advantage of situations where securities are overvalued. The next point has to do with absolute return seeking. Hedge funds seek absolute positive returns in all market environments, and that connects with what I just talked about. If a market is overvalued, then a hedge fund will seek positive returns by going short on overvalued securities. Most hedge funds tend to use leverage. This leverage can be directly through the use of borrowing or implied leverage through the use of derivatives. You might recall from your segment on derivatives that with a relatively small amount of investment or capital, the exposure that someone takes can be much more. Some hedge funds tend to have low correlations with traditional equity and or fixed income assets, and such funds tend to give a good diversification benefit. With respect to fees, hedge funds typically charge two distinct fees: a traditional asset-based management fee, which is called AUM or assets under management. This might be between 1% and 2%. And then there is an incentive fee or performance fee, which is a percentage of the profit. And typically this might be somewhere between 10% and 20% of the profit. Next, we have private equity and venture capital funds. Private equity and venture capital funds are privately held and actively managed equity positions. The firm, this is the private equity firm or the venture capital firm, invests in a company. So we have the private equity firm or the VC firm. This makes investments in various companies. These investments are private investments, and then the private equity firm is often actively involved in the management of these investments. And then the private equity firm is often actively involved in the management of these investments. The idea is to make investments over here at a relatively low value, but then exit these investments in a few years at a substantially higher price. So that is where the gain is coming from. The private equity and venture capital funds are generally structured as limited partnerships. This means that with the private equity firm, there is a general partner who runs the show. This is the general partner who raises money. The general partner makes investments in these firms. The general partner tries to make sure that the firms are being run well so that they can be sold at a higher price later. And then the money mostly comes from limited partners. So these limited partners make contributions to the fund. The investments are made by the general partner, and obviously when there is a profit, that profit goes to the limited partners. The general partners, though, get some share of the profit. So the general partners make money through a management fee. So this is like assets under management. Then there are some transaction fees based on which the GP can make money. The GP also makes money as a percentage of profits. So when particular investments are sold at a profit, a percentage of that profit goes to the general partners. That is called carried interest in the world of private equity. And then there is also some investment income because the general partner might also put some of his money in these investments. And when the investments do well, the general partner also makes money. A quick summary of this reading. You need to understand the portfolio perspective, which simply means that when you consider an investment, you should not look at that investment standalone. Instead, you need to look at that investment in the context of the overall portfolio. We talked about different investment clients. At a high level, you can have individual clients or you can have institutional clients. For each client, you need to understand the needs. There will be different time horizon needs, different income needs, different liquidity needs, and so on. This is exhibit 14 in this reading, which is extremely important. You need to understand the steps in portfolio management. There is the planning step, which allows you to create the IPS. Then we have the execution step, where we do the asset allocation, security selection, and then actually purchase the equities or securities. And then there is the feedback step. And finally, we talked about different pooled investments such as mutual funds, exchange traded funds, hedge funds, separately managed accounts, and private equity funds. The point in this reading is to understand how mutual funds work and then understand how the various other pooled investments are different from mutual funds.